Hi, this is Shade with Tax Sale Support with a short video here about secondary tax liens. I wanted to talk about exactly what secondary tax liens are, why they exist, and how they work. So, for starters here, let's talk about a couple of definitions here. First, if we're talking about technical definitions, a secondary tax lien is any tax lien that has been resold. Okay. Now the secondary tax liens we're talking about are a little bit different. We'll get into that in just a second. Now secondary tax liens are an easy way to get interest rate returns and also a way to acquire property. Now, essentially, what secondary tax liens really have to offer, and I think that they're the biggest positive for them is that they offer the best of both worlds. Really, they offer all of the benefits of tax liens, but without all of the time and work required normally to invest in liens. And there's a reason why that work is reduced and why it's easier to do, but that's mostly what it's about. It's about making the investment easier. It's about making it more accessible to people that maybe don't have the time or maybe haven't bought a lot of stuff themselves, but believe in tax liens. Now, they're also a good way to reduce the duration of your investment. And I'll see if I can explain exactly how that works here in just a moment. So one of the first things you need to understand is that banks and other large financial institutions have been investing into tax liens for many decades, more than 100 years. They have been purchasing tax liens for a long time directly from the county. Now, some of you might ask why, but the reasons for banks and financial institutions to invest in liens are the same reasons for you to invest in liens. And that is they offer the highest level of investment security. You won't find a higher degree of investment security out there. Also, they offer a high rate of return. Okay, so we're talking about interest rate returns of 8 to 20% annually. Simplicity is a big part of this. Banks love simple investments, and there's nothing easier for them than buying tax liens because all they have to do is sit back and collect checks in the mail as properties redeem. Now, the other side of that is that oftentimes these large institutional bidders are able to buy them in bulk. So that also simplifies the process because they're able to buy a whole bunch at once rather than needing to purchase one at a time through various agents at the auction, which is actually how they used to do it. Now, it's also important to remember when we're talking about tax liens that the primary objective with a tax lien is for it to redeem. That's what happens 95+% of the time is redemption. And that's the way it's supposed to work. That is what's intended. We want the property to redeem because when that occurs, that's when you get your high interest rate return. In fact, you're trying to pick out the properties, the liens against properties that you think are most desirable. Now, when I say the banks are only after the easy money, what I mean by that is that they literally just wait for liens to redeem and collect those checks in the mail. They're actually rather lazy about any kind of follow up with it. And so, as the numbers go, the vast majority of their liens redeem. So if you're buying in bulk and 90% of your liens, have redeemed, or 85% of your liens have redeemed, then the majority of those redeemed, and now they just kind of have those ones that are left over. Now, what ends up happening is sometimes these banks will sell those liens to investors before the redemption, before the property is redeemed. So sometimes they will sell those liens to investors, and the reason for that is because again they're only interested in interest rate returns, and so for them they want to keep it as simple as possible. And if somebody will come in and basically buy out the spot with their investment, they would prefer that because they have no desire for property. Now, currently, all of our All of our secondary inventory right now is located in Florida, and we like it that way because we understand Florida state laws fairly well, and so there are no surprises. We understand how things work there, and it's a great system for secondary liens. Now, why else? What are some other reasons why banks would sell their liens? Because there are several reasons. But one of the reasons is, again, the majority of their liens have already redeemed. They have no interest in acquiring property, and they never initiate the foreclosure process, meaning that when you purchase a lien, it has a redemption period attached to it. And the way it works is the property owner has up until that time period to pay off the lien. But if the redemption period comes to an end, let's say that's 2 years, and the property owner still hasn't paid off the lien, then the lien can suddenly be used to foreclose on the property. So that changes. So what we're saying here is that the redemption period can come up to an end with some of these big institutional bidders, and they won't do anything because they're lazy about it. They don't want the property. And so that's where we come in as investors, because the process for initiating the foreclosure process in California is very simple. I'm sorry, in Florida is very simple, and not one that requires a lot of work. And also, it's a self-executing foreclosure state, meaning that the county handles the foreclosure proceedings. Some states have non-self-executing foreclosure, and some states have self-executing foreclosure. So it's nice when they do have that, because the county handles everything related to foreclosure. Now, many of the liens that we have will be close to or will be foreclosure ready. So foreclosure ready tax liens, what exactly do we mean by that? That means that the institutional bidder that purchased them originally held on to them, and their redemption period is either almost up or it's already over. Now, something else that's important to note here is what's called the redemptive value of tax liens. And that is, tax liens increase in value with time because interest is accruing. So whatever that interest rate might be, every month it increases by 1.5% if it's 18%, and so on with the math. Now, it's important to remember that because at different points in purchasing the lien, it has different values. And that's because if the lien were to redeem at that time, that is the amount that the check would come for. So, for instance, if you were to buy this tax lien, a $1,000 tax lien on the day of sale, and you're earning 18% on it, then after a year, the lien is now no longer worth just $1,000. Now it's worth $1,180 because you've added that 18% interest rate. By year two, that amount has doubled again, so it's $1,360. So that is what the redemptive value of the property is, and that's based on the amount that it will redeem for when the property taxes are paid off, because the county's not going to cut anybody any breaks on it. So essentially, they're either going to pay the property taxes off or the property will be foreclosed on. So that's something else that's important to remember. Now, if you would like to talk with us about secondary tax liens, then simply click on the link in the description, fill out the Advisor Consultation Call form. It's like the one you see below, and we will contact you to schedule a time to talk. So we hope you'll do that.